Welcome to Retiring Today. If market volatility has you feeling uneasy about retirement, you're not alone. The good news, you don't have to stay in fear mode. Today we're going to talk about turning market volatility into opportunity. Two key strategies, dollar cost averaging and Roth conversions, plus how to build a recession-resistant portfolio. Hi, I'm Molly Nelson here with Loren, Merkle, and Clint Huntrods. They're both certified financial fiduciaries. Clint has a PhD, and Loren is a certified financial planner. And guys, all you have to do is open a search engine, type in recession, and the headlines start popping up, Loren. It's recession looming or X probability of a recession, and it can put people in fear mode, especially as they get closer to retirement.
And especially as you go one step further and you log into your 401k plan and it feels like your account value is on a trampoline where one day it's up really nice and the next day it's down, and you're just a couple years away from retiring. You think, how do I do this? How do I retire, give up the income and start taking money out of my savings and still have confidence that you can have the lifestyle that you want to? The anxiety increases and it just becomes a lot more problematic pulling that trigger and deciding to retire.
And don't you think, Clint, as people get closer to retirement, market volatility hits, they start asking themselves a lot of questions. Do I have enough? Do I have enough cash? Am I taking too much risk? I mean, you may have more questions than answers during volatility times.
Yeah, a lot of families just want to know, how much risk am I taking? How much do I need to take for my plan to be successful? So one of the things that I love to do with families is just help them understand more about how much risk you're currently taking today. If we did go through that market downturn, what kind of market returns might you expect? And then how do we get ahead of that and think about being more proactive?
Yeah, so if you're sitting at home and you see a headline or you log in and you're concerned, you might feel like you don't have control. The good news is that there are steps that people can take, and that's what we want to do today. But also, Loren, you've been helping people retire now for over 20 years, helping people build plans. And a lot of families and individuals that we work with, when the market volatility hits, they're not necessarily glued to the headlines or to the TV.
No, and we've had some downtimes in the market recently. I mean, 2022 was a downtime in the market. 2020, of course, how can you forget what happened in 2020? And over that time frame, yes, of course, we had conversations, many conversations with our families, and our families were definitely concerned. But what we saw that we're really proud of yet still today is very few of them took action that hurt themselves. And the reason why is because we had action steps in their plan that they could take to help themselves. So they were doing something, and that felt really good, but it was positive action instead of negative action, like something like going to cash and then missing out on the rebound eventually when something takes place. This volatility that we experience, we don't see it as a bad thing. Volatility has to happen as a part of everyday market movements, every year market movements. Volatility to us actually is opportunity. And now it's a matter of how you use this volatility to your best favor to create this opportunity, take advantage of the opportunity, as opposed to it just creating anxiety, fear, and bad decisions.
And one way to get out of that fear mode that can often accompany this market volatility is to understand history, to understand the historical perspective. Clint, since World War II, we've had 12 recessions. That's an average of one roughly every 6.5 years. They last about 10 months. And if you have an understanding of that, you'll know that if you're retired for 25 to 30 years, you are going to be retired in a recession.
Yeah, you just want to build that into your portfolio. Let's plan for a recession. It's going to happen on average every 5 to 6 years. So let's anticipate that, build proactively to be ready for that. And then also let's position so we have opportunities when those opportunities, when that market change happens and we find that volatility.
So let's say someone doesn't have a plan. Let's say someone doesn't really have an understanding of recessions, which, by the way, is easy to do. Again, the headlines make them seem kind of scary, and they do go to cash. Let's talk about the downfall. You mentioned it. People make emotional decisions. How can that really hurt their retirement?
Well, one of the downsides of going to cash is you have to make two good decisions. You have to make a good decision of when to go to cash, right? Your portfolio didn't lose so much before you go to cash, but then also you have to make a good decision on when do you buy back into the market. And oftentimes it's that second decision that is really hard, because when the market starts to rebound, the economy and businesses and everything that around us still feels really ugly. Things don't feel good when the market initially starts to rebound. Just remember back to 2008, of course, the Great Recession. Everybody remembers 2008, and it was March of 2009 when the market started to tick back up, and it didn't look back for over 10 years. But if you remember 2009, things didn't feel good. things did not feel good. It still felt really ugly. And in fact, it was 2010, 2011, 2012. People were still talking about how we weren't out of this bad time and we're going to actually reverse and dip back into something similar to 2008, but we didn't. And so if you were in cash and you didn't go back into the market, you missed out on one of the most prolific timeframes in the market that we have seen in our lifetimes. And that's one of the big risks of making a major movement like going to cash. You have to get it right the first time, but more importantly, you have to get it right the second time.
Yeah, if only we knew when the swings were coming, right? If only someone had a crystal ball, but no one knows exactly when those swings are coming. And Clint, it's really hard, to imagine, we're still working towards retirement. We've got some time, but if you're on the doorsteps of retirement, you've maybe gone to cash and you see your portfolio drop, that can be detrimental to your plan.
Yeah, and what we see is a lot of families are saying, this roller coaster ride that I've been riding, I don't know if I have enough time as I'm on the doorstep to retirement, thinking about potentially taking distributions out of these accounts. I don't know if I have enough time to go down and still make it back up. And that's where families are starting to realize, wow, I need to have a different shift in my investment philosophy than what it has been during my working years. And you want to do that proactively rather than reactively as you're right at the point where you're starting to take those distributions.
Yeah, getting ahead of it is the key. And that's what we want to talk about today, getting ahead of the next recession, of the next market volatility. So you have a plan in place before it hits. We'll talk about the plays that we help families build into their Retire Secure roadmaps, including dollar cost averaging next. Welcome back to Retiring. Today we're talking about market volatility and how to use that market volatility as an opportunity. Hi, I'm Molly Nelson here with Loren Merkle and Clint Huntrods. And Loren, when market volatility hits, a lot of times people maybe call up their advisor and they'll get some advice that could be incomplete.
Actually, that's a really good description of that advice. The advice isn't necessarily wrong. It's just there could be more advice to go along with it. I mean, think about the last time you had a conversation about this volatile market and what you should do with your advisor. What did your advisor tell you? He or she probably told you don't do anything, especially don't start selling off and go into cash to preserve. Well, for most people, that is really good advice, right? You don't want to sell when the market's down. However, we shouldn't stop there because there's a lot of other strategies that you could be implementing around your entire retirement plan to really put yourself in a better position once the market normalizes and start picking up back again. And one of those strategies that can be really effective is dollar cost averaging.
Well, good thing you mentioned that. We've got Coach Huntrods here. It's one of those plays that you guys build into the recession-resistant portfolios that you help families build. And Coach Huntrod, it's time to run the play. I want you to draw it up on the board for me, show me how to execute.
Let's go to the board to look at this example of dollar cost averaging. And dollar cost averaging is just a systematic contribution to an investment portfolio that somebody has. And they're going to continue to do that no matter what the market does. So when we think about how that could look in a market experience, what we're showing is one particular company. Now we want to be more diversified than a singular company, but for the purposes of walking through this example, we're showing just one company and its share price and how it changes over time. So over this 5-month period of time, the investor that we are looking at here is going to make an investment into this particular company. And in January, that company is offering a share price of $50. As we look at February, that trends down to $40 per share. And this investor is going to continue to buy in systematically each and every month, and they're putting $1,000 each month to work. Now in March, we see that this company continues to trend down. It's trading at $25 per share. The investor continues to put money in at $25 per share. And then this company kind of rebounds. As we look out to April, we go up to $35 a share. And then by May, we are actually back up to our previous price in January of $50 per share. So we see that the market goes down, or this particular company goes down, goes back up. It doesn't change that dollar cost averaging strategy that this particular investor is utilizing. Now we start to think about the impact of, okay, we've made those contributions. What does that add up to? And one way that we can start to look at that is just how many shares we were able to purchase during that time period. You see that when the share price was $50 in January, that was able to purchase 20 shares of that particular company. In February, where it was trending at 40, we were able to buy 25 shares. In March, wow, we see this. We see that at $25 per share, we were actually able to purchase 40 shares with our $1,000 that month. And that's a big difference from the example that we see in January at 20 shares that we were able to purchase when it was trending higher. But we can see the total shares, as we add those up, ends up being 133 and a half shares during this 5-month period of time, where the investor that we're looking at in this example had contributed a total of $5,000. Now, we really want to think back to this March example where it's trending at $25. We were able to purchase twice as many shares as we were able to in January with our $1,000. We really were able to purchase those shares on sale is a way that we can start to think about that. But overall, over this 5-month period of time, we see that we were able to purchase 133 and a half shares, which leads to a total cost of $37.45 on average per share. Now, if we were to look at an example and say, what if we didn't do dollar cost averaging? What could that potentially look like? And in this example, we're just going to say that this investor is going to put that $5,000 in one singular event, and they're just going to pick May. They don't necessarily know what that particular share is going to be trending at in that month. They just know they want to get an investment in the market, and so they choose May. They could easily choose January. Either way, they're going to be making that investment at $50 per share. So we see that they're only able to purchase 100 shares. Very different from the example that was utilizing dollar cost averaging. And this just starts to show that impact that can happen over time. And we obviously would rather have purchased in March, but what we do oftentimes see is that maybe somebody doesn't feel like they'd like to purchase in March because the current emotional sentiment is low. Maybe they wanted to wait and recover to make sure that stock was trending back up before they made that purchase. One way or another, what we can see is when we put that $5,000 in all at once, we've got $50 on average cost per share. That leads to 100 total shares that this example investor was able to purchase. A very big difference, averaging $50 per share versus our dollar cost averaging example that was more like $37.45 per share. Because we were able to, in this dollar cost averaging example, purchase those shares on sale, like I mentioned, that was able to get us a lot more investment for our money. We were able to purchase 133 and a half shares compared to, without dollar cost averaging, only 100 shares. When we think about that many more shares over time, our investment, you're going to find, can really explode.
One of the benefits of dollar cost averaging, not only as you illustrated, can you purchase more shares at an average lower cost, but it takes the guesswork out of this market. And that's one of the hardest parts about investing is nobody really knows when we're at the high or when we're at the low. And if you're investing or engaging in a strategy like dollar cost averaging, you don't have to know. You don't have to have the pressure of feeling like you should know. Put money in on a consistent, regular basis, and over the course of time, you will end up in a place that's better off, most likely, than just trying to pinpoint the exact down or mid parts of the market. And if you're sitting there thinking, that looks really powerful, I wish I could do that. If you have an employer-sponsored plan, like a 401k plan or a TSP or a 403b plan, and you're contributing every pay period, and you're lucky enough to have your employer matching that contribution, then you are already engaging in this particular strategy. And so you are taking advantage of the volatility, the ups and downs. And now it's about what other types of strategies can you implement within your overall plan to continue to enhance this opportunity of volatility.
And is this something you're doing when the volatility hits, prior to the volatility, after volatility, before retirement, or after retirement? I think I just asked you 6 questions all at once. So go ahead, Clint, no pressure there.
Well, what we're really trying to get at is dollar cost averaging is a systematic approach to investing. And it may be a fit for a particular plan, and it could be the 401k, or it could be in other ways where we're putting new money into the market, and then we have opportunities to actually buy those shares on discount when we see a downturn and when we see that volatility. Now, we obviously would love the opportunity to take more money in that downturn. Sometimes that's hard to predict, it's hard to time, but if there's ever an opportunity to dial up risk or purchase more in the bottom, now that can be more of a one-time approach and an opportunity that might present itself in somebody's plan.
And there's a lot of people watching the show right now that says, yeah, Loren, Clint, Molly, that sounds really good, but I'm retired, so I'm not currently contributing to any type of a retirement account. How can I take advantage of this? Within the plans that we built for the families and individuals that we serve, we incorporate a dollar cost averaging strategy. So when the market's good, yep, we're happy with what's going on the upside. But when the market's bad, we're not losing on that particular piece of the portfolio. And we can take a piece out of that, put it back in when the market is low. And then that way, this element of the portfolio didn't receive any of the down, but it will receive most of that up eventually when the market does come back up. So even if you're retired, this can be a really effective strategy, but you have to put the plan in place. And this element of the planning, to answer your question, Molly, needs to take place prior to the market really going down. But almost everybody, all of the above, right? Before the market volatility, after the market, during, this strategy can be highly effective. You just have to have an effective plan for it.
And what I'm also hearing is how much and what time and at what age is all dependent on you. It's dependent on your situation. It's dependent on your retirement goals. When do you want to retire? What kind of lifestyle do you want to live? So the answer to the 5 questions I just asked Clint, yours are going to be different than your neighbors or your coworkers. A great opportunity to talk directly with a retirement planner about your retirement and the questions that you have is a Retire Ready call. You can schedule a Retire Ready call right now by going to retirereadycall.com. It's pretty easy. There's a calendar there. Choose a date and a time that works for you. And then it's a casual, low pressure conversation about your retirement. We've got more opportunities to talk about when it comes to market volatility next. Welcome back to Retiring Today. We're talking about market volatility and how you don't have to be in fear mode. You can take advantage of market volatility as you move to and through retirement. Hi, I'm Molly Nelson here with Loren, Merkle, and Clint Huntrods. We talked about dollar cost averaging. You did a great job of drawing up that play. That was one of the plays that you help people build into those recession-resistant portfolios. Now, Coach Merkle, we're gonna draw up Roth conversions. You're not moving over to the board,
No.
but Roth conversions are something that people can use in their retirement plan, but definitely in market volatility times.
It certainly can be a really effective play. What a Roth conversion is you take money from your pre-tax IRA and you shift that over to a Roth IRA. Now, in the year that you shift it to the Roth, it is going to be taxable at your ordinary income tax bracket. But once it gets to the Roth, it grows tax-free forever. And this is one of the ways that the conversation that you're having with your advisor can be incomplete if you don't talk about this type of play. If the advisor just says, don't do anything, just hold tight, and you don't discover, does a Roth conversion make sense or not, then you could be missing out. That's an incomplete conversation. But it can be really powerful when the markets are up, but it can be even that much more powerful when the market's down, because you're going to get that growth back when the market comes back. It's either, do you get it back underneath the taxable account, or do you get it underneath the tax-free account? And we really like tax-free growth.
And Clint, some people will really appreciate seeing what this looks like in numbers.
Yeah, if we were actually going to think about a particular family, and this is part of that more comprehensive retirement plan, is we want to be looking at what opportunities you have to reduce your cumulative tax bill in retirement. So in a particular year, we might have identified and earmarked that we want to convert about $50,000. Now, if the market is kind of at a higher point, maybe a company share is trending at $100 per share. If we were to convert that $50,000, that would allow us to shift 500 shares from the pre-tax to the Roth bucket. But if there's market volatility and that company's share price is trending down at 80, and it doesn't have to be a one particular company, it can be a fund, it could be an ETF. We're just using this for the purposes of understanding how many more shares you could get. You'd have 125 more shares that you can convert with that $50,000. 625 versus 500 if you convert it at a higher point in that year when the market is a little bit of a higher point compared to if we converted at that lower point. So you can see now we've got 125 more shares that we were able to convert, and like Loren mentioned, that's going to be able to grow in that tax-free account moving forward.
And sometimes one of the questions people have is, do I have to sell my shares in order to convert? And you don't have to. Sometimes you might want to sell those, but in a case where the market's really bouncing up and down, if you have XYZ stock in your pre-tax IRA, you can just take 50 shares of XYZ stock and move it to your Roth, so you don't have to worry about missing out on any of the gains that could take place while you're making that transition. So you do have those options when you're making that Roth conversion.
And also, sometimes a Roth conversion does make sense, though not in times of market volatility too. This can be a part of a retirement plan throughout retirement, even before you retire too.
Yeah, and it's something that we want to sit down and help every family evaluate year in and year out. What tax opportunities are there? What strategies can we help you execute to help you lower your cumulative tax bill in retirement? Roth conversion can be a great strategy, and there are many more that are out there. And we always want to make sure now that we're thinking in retirement, let's not just make investment decisions, but let's see how that investment plan filters into the tax plan, as you can see, and all those different parts of an overall retirement plan. It just starts to be a really different conversation, a different way of looking at your investment portfolio than maybe what it's been during your working years.
One of the benefits of having a plan, a proactive plan, is in times of uncertainty like right now, you already know what your Roth conversion capacity is going to be. I just had a conversation last week with somebody. We knew that he was going to convert 30,000 this year, because when it comes to Roth conversions, priority one, does it make sense to you from a tax standpoint? And if you can answer yes to that question, now can we time it with some of this downward market volatility to improve the benefits of that Roth conversion? So he sent me an email. He said, hey, Loren, is it go time? Is it go time? We know we want to convert 30. Is this the time to convert at least a portion of that? Yep. And we concluded based on our conversation, yeah, we're not going to do the full 30. Let's do 15. And then we have some room to do the other 15 later down the road if the market keeps going like this.
And what a great position to be in. So you see the headlines of S&P down such a percentage, and you see it and you think it's go time, as opposed to thinking, do I have to come out of retirement? Am I still going to be able to retire? I think that people watching really want that. And in order to do that, it's building a recession-resistant portfolio. So the plays are in there, but also, Clint, it's the comprehensiveness that makes it recession-resistant too, because it doesn't just focus on investments. We're taking a look right now at a Retire Secure roadmap. This is the visual representation of the plans that you help families build. And it starts with the lifestyle portion, where you ask people, hey, what do you want to do in retirement? How do you want to spend your time? Then you work from there to fund it using all of those pieces of that pillar.
Yeah, and we really start to think about that income plan becomes important in retirement in conjunction with market volatility. We want to make sure that we can still deliver you consistent income in retirement no matter what the market's doing. And that's a big shift from those years as you're working, where you're looking to put more money in. Now, as we think about the potential to take distributions out, we need to have a really different investment philosophy and strategies that are in place to make sure we can get consistent income no matter what the market's doing. We also want to make sure we're making the right healthcare decisions. We talked about a Roth conversion. That's going to influence our taxable income in a given year. We want to make sure that doesn't have an unintended consequence on our healthcare plan and what we're going to pay for a healthcare premium. So you can just start to see how all these different pieces of a retirement plan fit together, and they all need to be working in conjunction to help you be as efficient as possible in retirement.
And some people might find it interesting that we had this whole show about market volatility, but we really haven't discussed investment portfolio construction. The investment plan is a piece of the overall retirement plan, but we have to have all these other pieces working together with it. But when it comes to developing an investment plan in retirement or going to retirement, you want to make sure that it is recession resistant, because you already know recessions are going to happen. Hopefully over the course of your 25-year retirement, you see 4, 5, 6 of them. So now it's a matter of being protected when we go through it, prior to going through it, and then having actionable strategies that you can put in place to make sure that you don't get destroyed with the market volatility, but you can actually benefit from it. And then of course we have the legacy pillar. The legacy pillar is a part of that plan that kind of wraps it all together, make sure your final wishes are fulfilled eventually when you do have your last day.
And today we only discussed a couple of the plays that you work into people's plans. There are more, and they're specific to everyone's situation. In a Retire Ready call, Clint, you take a lot of questions about, hey, what should I do? And you're sometimes able to give people action steps right during that call.
Yeah, we get a lot of questions about market volatility and what's happening in my 401k plan, for example. Some families are surprised there's so much volatility happening in their plan when they maybe don't think they're taking as much risk as they actually are. So that's always something to get down to more of the specifics on how are you invested? Are there any lower risk strategies offered in your 401k that might be appropriate to consider? And we just enjoy an opportunity to get to know what you're thinking about when it comes to retirement, see what kind of questions you have, and just learn more about what it's like to have that more comprehensive planning approach.
You can get your questions answered, or at least a couple of questions in a low pressure conversation with a retirement planner by going to retirereadycall.com. You can schedule your call today. This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.